Hello, my name is John Cavalieri. I'm an asset allocation strategist here at PIMCO. Today I'm joined by Rob Arnott, founder and chairman of Research Affiliates, the sub-advisor and partner with PIMCO in our joint management of the All Asset Fund. Rob, tell our audience how and why investors can use the All Asset Fund as their solution to access diversifying markets.
Sure. Unlike most global asset allocation strategies, it truly diversifies. It doesn't just hug very close to the classic 60-40 balanced portfolio. It is a strategy that offers a real return trajectory. It is a strategy that offers access to a whole host of liquid alternatives markets. And people could create that kind of portfolio by cherry-picking individual markets, but then they have to monitor those individual markets. We do that for them. So we handle the tactical decisions, PIMCO handles the management within the asset classes, and all of that creates this solution.
So that segues right into a question we hear a lot from clients, which is, if the fund has had such strong returns since its inception a decade and a half ago, what are its unique attributes that position it well to continue doing that going forward? Firstly, I think it's worth acknowledging that the backwards-looking return over the 15 years have indeed been impressive. Not only achieving our long-term secondary benchmark of CPI plus 5%, but actually modestly exceeding it, net of fees and expenses. I think what's helped underlie that and what supports that potential going forward are three key elements to the product design. One is a home base of markets that is not anchored on mainstream domestic 60-40 US stocks and bonds. It's actually the inverse of that. All the satellite, diversifying, inflation-sensitive markets, which are usually fringe allocations in most GTA programs, that's the core of All Asset. And our work clearly suggests that those are the markets that have outperformance potential going ahead. Number two, it's not just getting passive exposure to those markets, but it's getting the incremental return potential through PIMCO's active management of each. Each of those we obtain exposure to through actively managed PIMCO funds. And thirdly, importantly, the contribution from Research Affiliates. It's not that we hold static allocations, but the tactical management of those, emphasizing those markets with high yields, low prices, and high forward-looking returns at the expense of those with low yields, high prices, and low forward-looking returns. So those three elements are really what distinguish All Asset, have contributed to its historical return accomplishments, and certainly set it up well as we look ahead today. Okay, Rob, we've touched on some of these topics in general, but now let's just close with some specifics. Where do we see the most value today? What's likely to really be the key drivers in returns for the All Asset opportunity as we go forward?
Today, bond yields are 2 and change. And stock market yields are 1.5 to 2. The Shiller PE ratio, price relative to 10-year smoothed earnings, is at 31. 31 times the sustainable long-term average earnings for the US stock market. Our forecast for mainstream US stocks and bonds, just about identical, 0.5% above inflation. That means about a 2.5% return for mainstream stocks and mainstream bonds for the next 10 years. Ouch! That's not what people are expecting from their stocks and bonds. If you look at the diversifying markets that are our core holdings, on average they're in the 3 to 4 range, above inflation, which means 5 to 6 total return. We don't own them all equally. We choose the ones that are more attractively priced. PIMCO manages assets and has a record of adding value across multiple asset classes spanning decades. And so the opportunity to deliver CPI plus 5, I think, is better now than it was in 2002. But for the 60-40 investor, good luck. I don't think CPI plus 5 is in the cards at all. So I look ahead to the coming 15 years as a period of time when these diversifiers are likely to be just marvelous.